Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So now I'm continuing the next topic on the subject financial decision making. So far I have completed the different topics in this subject. Financial statement analysis, ratio analysis, financial management, cost of capital. These are all the topics I have completed in the subject of financial decision making. Now in this video I'm going to start a new topic, that is raising capital. In these videos I'm going to explain you about the meaning of the term raising the capital, financial market, functions of financial market, and types of financial market. So if you want the perfect knowledge on the subject of financial decision making, watch the video till the end. Don't skip in between. And remember, doing the problems is not the end of the matter. You must be theoretically clear regarding the concepts. So watch the video with full concentration. Before starting the explanation of this topic, take a screenshot of the points which I have written on the board. Then I'll explain all the points in detail. Now, raising capital. This is the topic of this subject. First of all, the meaning of the term and importance of capital. Capital is the lifeblood of a business. We can't imagine any organization, whether it is small, medium, or large, without capital. Capital are the funds required for acquiring the non-current assets, fixed assets, and also for operating the activities. So without funds, without capital, no business organization can function. So here, capital is the lifeblood of the business, and raising capital is the process of raising the funds. Because nowadays, an organization requires huge capital. And before raising the capital, it has to evaluate from where we can be able to procure the funds, raise the funds. Now, raising the funds, actually, it is nothing but the activities which are concerned with raising the funds. Capital raising relates to the actions that a company takes in order to raise the new capital to finance its activities. Now, here I am giving the definition of the term raising the capital. Raising that capital is that activity of the business organization which is concerned with all the activities relating to procuring the funds required for the activities of the business. Now, capital is required to build assets. Actually, the funds, the capital is required to build the assets, to purchase the assets in order to generate the income. Income will be generated by investing the funds in assets. So that is the purpose, need. Then raising capital is also called funding of the company. That means funds from where we have to raise, procure the funds. Then an organization can raise capital in two ways, broadly divided into owner's capital and borrowed capital or debt capital. Owner's capital is the shareholders fund, share capital, and outsider fund is the debt capital, debt fund. So broadly we can divide into owner's fund and outsiders fund. Both debt fund and equity capital can be raised by issuing the units in small denominations. Suppose the company requires a huge capital. The company cannot procure huge capital only from one source. So what the company will do, the company will divide the entire required capital into small unit denominations. Example, a company requires suppose 10 lakh rupees. So directly 10 lakh rupees will not be procured from one party, from different parties. So 10 lakh rupees will be divided into 1 lakh units. So each unit has a denomination of 10 rupees. Like this, the company will raise the funds. So I have explained you about the meaning of the term raising the capital. Now I am coming to the next topic, that is financial markets. Normally, market is a place where goods are bought and sold. But here financial market is a mechanism where funds are borrowed and invested. Where funds are borrowed and invested. So two parties are there. Some people require the funds and some people are there who are having the funds and they want to invest. So here borrowers and investors will meet at each other in a market called financial market. The market where financial instruments are traded. Actually, the funds are borrowed and lended in the form of instruments. Like example, stock, shares, debentures, bonds. These are the instruments. So financial market is a market where these financial instruments are traded, means bought and sold. In this market, traders buy and sell securities. What are the securities? The stock, the shares, the debentures, the bonds, the currencies, derivatives. These are all the securities, and these securities are traded, means bought and sold. Then the securities include stock, bonds, foreign exchange, derivatives, etc. These are the different forms of securities which are dealt in a financial market. Now the financial market includes, we can classify the financial market into different categories. The categories are money market, bond market, equity market, currency market, derivatives market, etc. Many types of markets are there. We can classify it. Now, secondly, financial market can also be classified. Another method of classification is primary market and secondary market. We will discuss all these points regarding the classification of financial markets. Now, primary market, briefly I'll explain. In the coming video, I'll explain in detail. So briefly, primary market are those markets which help in creation of new securities. That means the capital can be raised by using this primary market. It is a new shares market. When the first time securities are issued in the market, it will be issued in the primary market. Example, a company first time it is issuing the shares, it is issuing the stock. So when first time the company issues the stock, the market will be called primary market. New securities are issued in order to raise the capital. For fresh capital is raised by investors by issuing new securities. New capital, that means capital formation. Capital formation is done in primary market. First time the investors are buying the security which are issued by the company. That is called primary market. Now secondary market. Secondary market are those markets that facilitate buying and selling of existing securities. No capital formation is taking place in secondary market. In secondary market, liquidity of assets are taking place. That means the existing securities can be transferred from one person to another person. Example, Mr. X is having 1000 shares and Mr. X is in need of money. So he can sell the shares in the secondary market. In secondary market, he will find any buyer is there. So many buyers are there. So Mr. Y wants to buy and Mr. X wants to sell. So X is the seller, Y is the buyer. They will meet in a secondary market where the shares will be transferred from X to Y. Only existing securities are transferred from one person to another person in secondary market. They provide liquidity to investors. Liquidity means converting the security into cash and cash into security. That is called liquidity. Now I am coming to the next topic called functions of financial market. Actually, what are the activities this financial market will provide? What are the functions it will provide? First, providing capital. See here, for the economic development of a country, we require fund. A country will be developed only when it is having sufficient capital formation. So this financial market will help in capital formation. When there is capital formation, then economic development take place in the country. So it will provide capital. There are many companies, many business organizations, many ideas they are having to form the business, but they don't have the capital. So they can approach the financial market in order to raise the capital. In financial market, so many borrowers and so many lenders will come. The lenders wants the security and return of their investment, and borrower wants to borrow in order to expand their business, in order to grow the business. That is the first function, providing capital. Secondly, creating liquidity. Financial market will help in liquidity. Liquidity means converting the securities into cash. For example, Mr. X is having 1000 shares. He has purchased the shares in order to get the return. He has invested in share market to get the return. But later on, at a particular point of time, he need cash. So simply, he go to the secondary market, sell away the shares and get the cash. So liquidity is possible in case of financial market. Your money will not be blocked always. At any time, you can convert your securities into cash and cash into security. So liquidity is possible. This is the function of financial market. Risk transference. See here, there are different people. Some are risk takers and some are risk averse. A business organization see that there is a lot of risk involved in their business. They want to transfer the risk. They are called the hedgers. Protecting the business from risk, they are called hedgers. The hedgers will transfer the risk by using this financial market, by entering into hedging agreement, that is derivatives market. Suppose I am having a business and my business is more exposed to risk. I want to transfer my risk. So I will enter into derivative market, that is a financial market, in order to reduce my risk. And some people are there who are risk takers. They will take the risk in order to get more profit. They are called speculators. They are called speculators. They want to take the risk in order to earn more profit. So different people are there. Some are risk averse and some are risk takers. So we can be able to shift the risk. Risk will be transferred from one person to another person in the financial market. Last one is transparency. When a transaction takes place in a market, the market is fully regulated by law. Everything is completely transparent. There won't be any misrepresentation, there won't be any fraud. Some fraud may take place, but it is completely regulated by the law. That means all the transactions are completely transparent. So these are some of the functions of financial market. In examination, you may be asked a question regarding what are financial markets and what are the functions of financial market. So just know what I have discussed, what I have explained. Watch with full concentration, listen it carefully. You can be able to write in examination the theory question regarding financial market. The next topic is types of financial market. We can divide the financial market into different categories, different classes. Now we'll study one by one. First of all, money market. Money market is one of the form of financial market which is concerned with short-term lending and borrowing. So in this money market, the business organizations wants to borrow for a short period of time. For example, from 1 day to 1 year. Normally, in the case of banks or financial institutions, they deal in money, so they will find shortage of money at particular point of time. They want the funds only for 1 day, 2 day, 5 days, 1 week, like that. So these short-term funds can be borrowed and lended in case of money market. Then second one is bond market. It is a long-term debt market, where long-term debt is borrowed and lended. For example, a company requires long-term debt. For raising the long-term debt, it will enter into a bond market where banks, financial institutions, these will lend the money for long-term purpose in the bond market. Next one is debt market. The debt market is a market where debt is raised and issued. Raised and issued. So in the debt market, it can again be classified into short-term debt and long-term debt. The short-term debt in case of money market. For debt instruments, money market is market for short-term debt, while bond market is market for medium or long-term debt instruments. The short-term debt can be taken in money market. Long-term debt can be taken in the bond market. Next comes equity market. The market for equity shares. Equity shares are the real owners of the company. Equity shareholders are the real owners of the company. One of the advantage of equity is that means the return is not fixed. Comparatively, the return on equity will be higher than the return which is paid on debt, because they are the ultimate risk takers. They will get to the profit only after making all payments to all the other parties like debt, like interest on debt, etc. When everything is paid, afterwards if some amount is left, then only equity shareholders will get. And secondly, there is no time period for redemption. That means once a person purchases the shares, the money will not be refunded. The money will be blocked in the company. Only at the time of liquidation, the equity capital can be returned. Then capital market. The combination of debt market and equity market is called capital market. So both the market will come under capital market, equity market and debt market. So capital market can again be divided into primary market and secondary market. Just now I told you primary market is a market where the shares are first time issued by a company to the public. Fresh new securities are issued. That's why it is called IPO, initial public offer in primary market. Then secondary market is a market where the existing securities are bought and sold. The liquidity of securities will take place in secondary market. Next comes Forex market. Forex stands for foreign exchange. It's a market where foreign currencies are bought and sold. The people require foreign currency either for export or import or making the payment in other countries. Nowadays, due to globalization, the funds are easily transferred from one country to another country. Similarly, exporting the goods, importing the goods require conversion of one currency into another currency. So here, some people want foreign currency and some people want to sell the foreign currency. Example, if we are the importers, so for importers, we require foreign currency to make the payment. Similarly, if we are the exporters, we are getting the foreign currency and we want to convert the foreign currency into home currency. So some people want the foreign currency and some people are selling the foreign currency. So buying and selling foreign currency will take place in Forex market. It is international market. It works 24/7. There is no sleep for Forex market. Forex market will never sleep. Then it is almost 24/7 market. Exchange rates of various currencies keeps on changing. The exchange rate between one currency and another currency, the exchange rate will not remain constant. Every hour, every moment, the exchange rate will change on account of the demand and supply of foreign currency, and apart from that, so many economic, financial and a number of other factors are there which affects the exchange rate. That is Forex market. Last market I am explaining here is derivatives market. A derivative is an instrument. It's an instrument which derives its value from the value of the underlying asset. The underlying asset may be stock, bond, foreign currency, derivative, etc. So here, derivatives are financial contracts. Actually, it is an agreement which gives the party the right to buy or sell a particular underlying asset. So derivative is an instrument which gives the one party a right to buy or sell the underlying asset on the terms that agreed now. That means the agreement is made now, but the selling and buying will take place on a future date. For example, I need suppose some $10,000 after 3 months. So after 3 months I need $10,000. So presently I enter into a contract with the seller of the currency. For example, bank. I will go to the bank and ask the bank manager that after 3 months I require $10,000. So bank manager will say, okay, after 3 months we will supply you $10,000 at the rate of rupees 79 per dollar. Suppose example, 79 rupees per dollar. So agreement is made now, but after 3 months I will purchase $10,000 at an agreed price of 79 from the bank manager. And bank manager is bound, obligated to supply $10,000 to me. So agreement is made now, but the settlement will take place on a future date. So normally this derivatives market will apply for hedging, protecting the business against risk. But nowadays, this derivative market, more and more speculators are coming to take the advantage. Speculation is the activity which is concerned with taking the advantage from the market movements. Market situation, they want to take the advantage. So derivatives are primarily risk management tools. However, they are largely used for speculation nowadays. So actually derivatives was started mainly for risk management tool. But nowadays speculators have entered to take the advantage in the derivatives market. So in this video, I have explained you about the raising capital. What do you mean by raising capital? What do you mean by financial market? What are the functions of financial market? And what are the different types of financial market? In the next video, I'll explain you the other part of this topic called raising the capital.